why did it make sense to buy this business inside of a bank as opposed to just another venture that you had outside of the bank?
Because in a financial company should never be valued on EBITDA multiples, right? You should be valued on earnings multiples because my biggest cost is always interest expense,
Right.
right? I'm selling money. We talked about how we buy money from depositors. Now let's talk about how we sell money to borrowers, whether they're real estate borrowers or truckers. So if you've got a bank that's 10 times levered already, that has a cost of funds around 1%, and you can put a factoring business that has a portfolio that's yielding 20% inside the bank with 10 times leverage, that is rocket fuel for a bank. And you can't hide it. You can go back and look at our numbers. Our net interest margin is in the top 1% of all banks in the United States of America. And the reason is because we've scaled that business inside the bank because the factoring company gets to use those deposits. And, with all due respect, I'd love to lend you money at 3.5% on your first and main real estate deal. But I'm a yield junkie, right? And my job's to make money. And I do a lot better lending it out at 20% yields to these truckers. And just so you understand, it's not, people would say, well, that sounds like payday lending. Well, we do the whole back office for them. We are their back office. And so our cost to service these little $2,000 invoices is roughly 10% of the asset. So if I'm not even lending at 10%, I'm not even breaking even. It's a high touch, high friction, industry. Now, what we've been able to do because we've built such scale is it's allowed us to use technology to drive down those operating costs. But you are essentially that trucker's back office. You're talking to them 3 times a week. You're telling them this is a good credit. This is a bad credit. We won't buy this invoice, haul for them. And you do that inside a bank because of that superior funding advantage. All other factoring companies that are not bank owned are having to borrow from a bank at 3 or 4% and then turn around and lend it out. And they're only allowed 4 times leverage, right? I'm borrowing at 1% because I'm buying funds from FDIC insured depositors and I have 10 times leverage and I'm making the same yield. So that's why it makes us look different.
So what you just said is, Chris Powers LLC calls a trucker and says, hey, will you haul off a bunch of my new Chris Powers water bottles? That trucker might call y'all and say, hey, will you just look up Chris and see if his company's worth a damn? And y'all's business could call him or kind of tell him back and be like, that would be a high risk deal. Like y'all are actually helping make the decision on who they should haul for or not.
Absolutely. Like we told truckers.
And my water's great, by the way.
I'm sure it looks lovely. We told truckers a few years ago, we're not buying any more Chesapeake invoices. So if you want to haul for Chesapeake, be free to do that, but we're not going to buy the invoice. So you're going to have to do it out of your own working capital because we were worried they were going to go bankrupt. And look what happened. So those kind of discussions happen all the time. We're managing concentrations of credit and thinking about, again, factoring's different in that the trucker is not a credit risk. They're a fraud risk. You've got to make sure the invoice is legitimate. We get fraudulent invoices every day sent to us. So we have to be very sophisticated in that. The credit risk is the person for whom they hauled.
Yep.
Now we got to make sure that person is able to pay their trade payables in due course. And so we use sophisticated modeling to look for fraud on the one hand and to look at credit risk on the other hand.
So the fraud is some trucker that says, I just hauled this for Nestle. Here's an invoice. Pay me.
Yeah.
And if y'all aren't careful, you pay them, but they never actually hauled anything for Nestle.
Yeah. So we have algorithms built and even use some machine learning we can't verify every invoice.
Yeah.
I mean, we're doing 1.4 billion a month in purchases, $2,300 at a time. So tens of millions a day, tens of thousands of invoices a day. I have 375 people who work in that business. You can't verify every invoice. So you have to look at historical trends for individual customers and make educated guesses on what percentage of invoices you need to verify before you buy. But I mean, it can be just as simple as they use whiteout and they change a date. And it's especially if they run the same load frequently and then that load gets canceled, and they don't run it, but they just white out and change the date, submit the invoice. There's double brokering schemes. I mean, trucking is full of some of the most fascinating and many of them first generation entrepreneurs. I've seen them go from one truck to having 500 trucks. It's amazing to help these small business owners grow, but they're bad actors, no
Yeah.
question. And so yeah, they'll try to defraud you. I mean, it's a crime of opportunity, and the opportunity is every day.
Okay, so you meet Steve and you buy the factoring company inside the bank, and we've kind of talked about why that would make a lot of sense. Let's just kind of talk about the scale of like where the business was and kind of how we've grown it to where we're putting out did you say $1.5 billion a month?
Mm-hmm.
Yeah, so that you obviously didn't buy it at that. You've gotten it there and you've learned a lot along the way.
Yeah.
This is fascinating.
Yeah, we have. So 40 million a month is now, I think, 1.55 billion. We paid a $9.3 million premium to buy that business over its book value. And I ground my teeth over that. Because remember, we had just raised $45 million, spent a year cleaning up the bank, hadn't made any money. I was kind of out of friends who would take my phone calls, right? But I needed to raise $9 million to buy this business, to pay goodwill, right? You pay a multiple on earnings if you think something's going to be able to do it. And so, man, I had to beg some of my original investors to put another 9 million in so we could pay for the dilution, the tangible. Banks don't run out of cash. It's always about managing regulatory capital ratios.
Right.
So if you pay a premium for something, that dilutes your capital ratios. So we put the 9 million in. And then through the tremendous leadership of Steve Hausman, George Thorson, a bunch of people down through my current CEO out there, Jeff Brenner, that business now generates $250 million in revenue and about $130 million in net income annually. So it is the best investment we have ever made. I have ever personally been a part of. 90% of that growth has been organic through investing back in the business, through digital marketing channels, through creative things that other people dreamed up, not me. And then building technology, the technology to handle the volumes that we see right now, that would have been unimaginable to us in the early days. And and that business also gave birth to the idea of TriumphPay. So it's in a way the gift that keeps on giving. And what started as this was just an idea to put a factoring company inside a bank has turned us into, we are a transportation-centric enterprise now. Our whole future is about financial technology and transportation, and it all started with that investment. I didn't foresee it. There's no Harvard Business School, well-written paper. There's no PowerPoint. It was really just reacting to opportunity as it came, keeping your eyes open and getting great people and a healthy culture. And what that team has done at Triumph Business Capital is just, it's astounding.
It's unbelievable. All right, dumb question. It is a bank because it's owned in a bank.
Yep.
But are you really a bank? Like,
depends upon what you mean by bank.
I guess I don't really know what I mean. I mean, when I think as a real estate guy, a bank is like, I just think of your typical bank. But when I hear this story, I think of it as this incredible business wrapped up in a bank charter. Do you think of yourself as a bank, or do you think of yourself as a transportation company? Maybe that's the question.
Yeah. And I think you're catching me in transition. I think when people say bank, what most people think of is a community bank. Deposits in the local community, you take deposits from your members of your community, you loan money out in the community. But there's credit card banks that stand behind, American Express, for example, is a bank. There's merchant banks, there's investment banks, there's regional banks. What we are becoming is a financial technology bank for the transportation industry, which means we still have community bank operations and they do a lot for us, but we are not really what you would think of as a community bank. And I think we serve a very interesting purpose in being a bank. And And I don't say that because I'm a banker. Just look at the fintech companies who've gone out and raised money by pointing at, shooting at, making fun of what traditional banks, boring banks do. Eventually, they seek a bank charter themselves. Look at Block, which is Jack Dorsey's company. They sought a thrift charter, which is a type of bank charter. There's several, Varo and others, because what you inevitably find in the financial services world is there is much benefit to being a bank. You just don't have to run it the way your grandfather's bank was run.
Yeah. You're making me want to buy a bank, but you've already laid the groundwork that it might be hard to do.